One of Wall Street's very best, Philip from Jefferies, who is ranked number 84 on all of Wall Street, increased his Tesla stock price target. In a research report, he wrote, after a harrowing second half of 2022, the Austin Investor Day demonstrated Tesla remains very much a day one company. Lack of new product unveiled does not imply major growth delays in our view. Scaling up the Model 3 and the Y further through dynamic pricing could limit the scope for earnings surprises in 2023 and 2024, but benefit free cash flow and return on invested capital. And their DCF-based price target increased from $180 to $230. Jefferies also assumes that a vehicle based on the next generation platform could go into production as early as next year, second half of next year. In the research note, it is also said that Q1 is seen as a trough. From the next vehicle based on the next generation platform, they expect that the average selling price will be $25,000, but with a gross margin of 20%. I think all of the analysts also got a tour of the factory, and they are saying that they saw tangible progress on the dry electrode production as well as 4680 batteries, which they think will help Tesla get to $70 per kilowatt hour cost. Thanks to David for sharing the screenshot. We also have research notes from Mark Delaney from Goldman Sachs, who is a pretty highly ranked analyst on all of Wall Street, as well as Adam Jonas, who is also not that bad. Adam has been actually able to beat the market by 3.1% since 2014. That's not easy to do, generally speaking, if you have to pick dozens and dozens and dozens of stocks. This is Mark Delaney from Goldman Sachs. The bottom line is that we believe the event should increase investor confidence in Tesla's ability to reduce costs by 50% with its next generation platform, given the breadth and depth of Tesla's team and how its vertically integrated model allows it to optimize on both cost and performance criteria. Tesla provided significant insights into how various teams are working to reduce cost, scale, and improve capabilities. We believe the company was able to show good progress in areas such as casting, 4680 cells, such as with the dry coating of the electrodes, semiconductors, power electronics, and software. However, we believe many investors were hoping for more specifics on when a third-generation vehicle could be shipping, and therefore the lack of clarity beyond the comment that they are working as fast as they can, and it could be in the next couple of years, is likely to be viewed as a disappointment to some. I think that's how many people felt. However, after the Investor Day, Tom Zhu said that he wants to finish the building of the factory in Mexico faster than the one in Shanghai. So we sort of have a fairly clear idea of when the next generation vehicle is going to be coming out. We expect to see the permits and everything ready within 3 months, to a point where we can actually start building the factory in about 3 months, and then give it maybe another 9 months, or if there are delays, maybe a little bit more, and we should have a factory then. Of course, when you still need to install all of the equipment and the robots and everything. So give it a little bit over a year if you are slightly optimistic, and maybe quite a bit more if you are not. More than 2 years, I think, would be quite bearish. And about 18 months is really probably the middle ground. Because also Tom Zhu said the reason why Giga Shanghai scaled faster than Austin and Berlin did is because largely in Giga Shanghai, they just copied and pasted everything from Fremont. But in Austin and Berlin, they have, for example, in Austin, they have a 4680 line, and they are doing both castings for the Model Y. We're doing the front and the rear castings. That's why Tom Zhu, who is now perhaps widely considered as the number 2 person at Tesla, said that it took longer to scale up Giga Shanghai's production, and I would expect probably something similar in Mexico as well. Hopefully not, though. Hopefully not. Importantly, the event reinforced our positive view of the company long-term, meaning their competitive positioning. We believe this is especially important when considering that the automotive market is a long cycle industry and Tesla already has a leading position. That's to really put it mildly. The second place is not really that close. They are all the way in China. I would say BYD is in the second place. Toyota. Oh, did you see that last video about the electric Corolla, which is not really made by Toyota, it's made by BYD. And now let's take a look at Adam Jonas from Morgan Stanley. Tesla's audacious efforts on vertical integration are about to pay off. EVs are far too expensive today. Tesla gave a number of drivers for a 50% cost reduction for its next generation platform. In a race to the bottom, we seriously question how the competition can keep up. I am really liking Morgan Stanley. I mean, in a research note a few months ago, Morgan Stanley basically said that manufacturers that just make internal combustion engine vehicles, they should stop trying to make EVs because they are invested in internal combustion engine vehicles and they are not good at using capital effectively. But Tesla is able to take just a little bit of money and build a factory that produces EVs relatively quick and with a low amount of invested capital. You guys, you should just go bankrupt, basically, is what Morgan Stanley said a while ago. So I'm starting to like Morgan Stanley, even though Adam Jonas, when I bought Tesla stock in early 2019, he put out this bear case where he said Tesla stock is going down all the way to $10 in the worst case scenario. That's before the last two splits. So split adjusted, that would be 67 cents. Can you imagine that? Morgan Stanley is also positive about the progress in terms of battery manufacturing. So it looks like all of the people that had the tour of the factory and witnessed the production of the 4680 battery cells are thinking it was a good amount of progress that Tesla has made so far. And I liked this, a deep bench. Keyman risk has always ranked high on lists of investor concerns at Tesla. There were presentations from 20 different executives across all key operational disciplines. No teleprompters, and Elon Musk was actually featured fairly little in the overall set of presentations, including Q&A. The bench was pretty impressive, and actually Lars had a pretty good presentation earlier at the Investor Day. He's the one that explained this new way of manufacturing Tesla vehicles. I thought this presentation was one of the best ones, if not the best, that day. Not only was the content really good, but also the way it was delivered was pretty good too. And this point right here, I fully agree with Morgan Stanley. The non-unveil of Model 2 disappointed some people, but it should not have. From our experience, auto companies don't typically unveil far cheaper, potentially better engineered products far in advance. Imagine you just placed an order for a $50,000 Model Y, and Tesla tells you there will be a slightly smaller version for half the price with enhanced capabilities available soon. From a commercial standpoint, maybe not the best strategy. Overall, certainly positive, or at least neutral reactions from institutional investors, and certainly relatively positive from Morgan Stanley and Goldman Sachs, and very positive from Jefferies. Hopefully, our Tom can get that factory in Mexico built fast. That would be really good. I also started a Patreon account just now. This is the second video on there. Tesla could really surprise us here. And this is the Tesla stock buying opportunity explained by Elon Musk. My name is Matt Posius. Like and subscribe if you haven't yet, and I will see you in the next video. Thank you so much for watching.